Imagine two friends. One of them takes their entire $10,000 bonus and shoves it into a single, can't-miss stock. All in. The other quietly spreads that same $10,000 across a mix of investments. Fast forward a year. One of them is either bragging at every dinner party or quietly avoiding their account because they're broke. The other one? They probably aren't bragging, but they're sleeping just fine. Here's the real question. Which future are you accidentally building right now? Concentrating your money feels exciting. It might be a big stake in your company's stock, a hot tech name, or one sector that always wins. But excitement isn't a strategy. Let's put some numbers on this. If 70% of your $50,000 portfolio sits in one company and that stock drops 40%, your total wealth falls by 28% in one hit. That's $14,000 gone. Now compare that with the same $50,000 spread across, say, 6 to 8 different asset types and regions. That exact same company crashing 40% might only cost you a few percent overall. So the goal isn't to own a bit of everything at random. The real goal is to design a mix where different pieces respond differently to the same event. In this episode, you're going to learn 3 big things. First, how to check if you're secretly overexposed to one stock, one sector, or even one employer. Second, how much diversification is actually realistic when you've got a smaller portfolio. And third, how to adjust what you own so no single bet can quietly decide your entire financial future. Let's start with a myth a lot of people believe. Most people are less diversified than they think. Owning 15 tech stocks, that still might be just one big bet if they all rise and fall together. Real diversification means mixing different engines of return. Think, a core in global stocks, a chunk in bonds, a slice of real estate, and some cash. For example, something like 60% global stocks, 30% bonds, 5% real estate, 5% cash. Why does that matter? Because if one engine gets hit, it doesn't stall the whole machine. Your portfolio can keep moving forward. In this episode, you'll also learn how to spot hidden concentration, like when 40% of your net worth is tied to your employer, and how to build diversification even if you've only got $1,000 to $5,000 to start with. And then we'll talk about simple rules you can use to keep your risk steady as markets move around. So let's get practical. What does actually diversified look like in real life? Start with a really simple test. Grab a piece of paper or open a note on your phone. List every investment you own. Then, for each one, figure out what percentage it is of your total portfolio. Here's an example. Say your portfolio is $20,000 and you have $7,000 in one stock. That means 35% of everything you've invested is in a single name. That's high risk. A common rule of thumb is this. Try to cap any single stock at about 5 to 10% of your portfolio. On $20,000, that means roughly $1,000 to $2,000 per company. If you go above that, you're making a deliberate big bet. That's a choice, not an accident. Once you've checked individual positions, zoom out. Look at your mix of asset types, the big buckets. Maybe you have $12,000 in US stocks, $5,000 in international stocks, $2,000 in bonds, and $1,000 in cash. That works out to 60% US stocks, 25% international stocks, 10% bonds, and 5% cash. Now compare that to a target mix you choose based on your risk tolerance. For example, maybe your target is 70% stocks, 25% bonds, 5% cash. In this case, you're light on bonds and heavy on stocks overall. So what do? Adjusting toward your target might mean gradually shifting about $3,000 from stocks into bonds over time. You don't have to do it all in one day, you can move in steps. But you're nudging the portfolio back toward the balance you picked on purpose. Now, if you're starting small, here's some good news. You don't need dozens of positions to be diversified. With $3,000, you could build a surprisingly well-diversified mix using just 3 low-cost funds. For example, $1,800, 60%, in a global stock index fund. $900, 30%, in a bond index fund. $300, 10%, in cash or a money market fund. That's it. 3 simple building blocks. Then, as your portfolio grows, say from $3,000 to $30,000, you can add a little more nuance. At $30,000, you might add a real estate fund at, say, 5 to 10% of your portfolio, up to about $3,000. You'd trim your stock exposure slightly to make room so your overall risk level stays similar. Now, here's a piece almost everyone forgets. You have to include what I call outside the account exposure. This is money that's technically not in your brokerage account, but still tied to your financial life. For example, if you already have $80,000 of your employer's stock through options or RSUs, and your total net worth is $200,000, then 40% of your wealth is tied to a single company, before you even look at your retirement accounts. In that situation, you might want to hold fewer or no extra shares of that same employer inside your investment portfolio. Instead, you'd lean more on broad index funds, so your job and your investments aren't all riding on the same company. Now, even if you set up a great mix, the market doesn't stand still. As markets move, your percentages drift. Imagine you start with a target mix of 70% stocks, 25% bonds, 5% cash on a $100,000 portfolio. After a strong run in stocks, you check your account and now you're at 80% stocks, 15% bonds, 5% cash. That means you've got $80,000 in stocks and $15,000 in bonds. What changed? The stocks grew faster, so without doing anything, you quietly took on more risk. Rebalancing back to 70-25-5 would mean selling about $10,000 of stocks and buying $10,000 of bonds. What does that do for you? You're locking in some of the gains from stocks. You're bringing your risk back in line with what you originally chose. And you're doing it without trying to predict what's going to happen next week or next month. Here's an analogy that makes diversification really easy to picture. Think of it like building a meal plan for a month, instead of picking one superfood and eating only that. If you lived on just steak, you'd be in trouble the moment prices jumped, or your health changed. A balanced plan might look like this: 40% grains, 30% vegetables and fruit, 20% protein, 10% fats. If there's a shortage in one area or prices spike, you adjust your portions, but you still eat well. No single food can ruin your entire diet. Now translate that idea to money. Let's say you have $40,000 to invest. Instead of putting $30,000 into one hero growth stock and $10,000 into some random others, you decide each part of your money has a job. For example, $24,000 in broad global stock funds. This is your growth engine. $10,000 in bonds. This is your stability. $4,000 in cash. This is your flexibility. And $2,000 in a real estate fund. This is your inflation hedge. Now imagine one small holding that makes up just 3% of your total suddenly crashes 50%. That hurts, but it only costs you $600, not $15,000. You've turned what used to be one fragile pillar into something more like a 4-legged table. Any one leg can wobble, but the table still stands. As your portfolio gets bigger, these diversification decisions start to have much bigger dollar impacts. A 5% tilt when you've got $10,000 is about $500. The same 5% tilt on $500,000, that's $25,000. So it really pays to think ahead. Plan in advance how much you're willing to differ from a broad global index. That's often called tracking error. You might even write down a few simple rules like no more than 20% in any one country, no more than 10% in any one sector. Then stress test your setup. Ask, if stocks fall 40% and bonds fall 10%, what happens to my portfolio? Run that on a $100,000 portfolio, and then on a $300,000 portfolio. When you know ahead of time what a really bad stretch might look like, you're less likely to panic and undo all the diversification work you've put in. Here's the key mindset shift. Diversification is a habit, not a one-time fix. You don't set it and forget it forever. You create a range that you're comfortable with, and you check in once in a while. For example, you might say, I want stocks somewhere between 60 and 80%, and bonds between 20 and 40%. Then you review once a year, or whenever you've added $5,000 or more in new savings. As your income rises from $40,000 to $80,000, and your portfolio grows from $10,000 to $100,000, you keep automatically directing each new paycheck across your different asset types. That way, your risk stays aligned with your life without constant guesswork. All right, let's pull this all together. So here's what we covered today. First, we talked about why putting too much money in one place, one stock, one sector, even one employer, is like balancing your whole life on a single egg basket. It can feel exciting, but one crack can set you back years. Second, you learned what real diversification looks like. Not just owning lots of things, but owning different engines of return. Stocks, bonds, real estate, and cash that don't all move the same way at the same time. Third, we walked through concrete examples of how to build that mix at different portfolio sizes. Whether you've got $3,000 or $30,000, you saw how a few low-cost funds can give you global exposure and a smoother ride. Fourth, we looked at the hidden risks most people miss, like having 40% of your net worth in your employer's stock, and how to factor in those outside-the-account exposures when you decide what to buy. And finally, we talked about keeping your plan on track over time, using simple rules, rebalancing when your mix drifts, and stress testing so you know how your money might behave in a rough market. Now, what do you actually do with all of this? Here's your action plan for this week. Step 1. Take a few minutes to write down the key ideas that stood out to you about diversification, about not putting all your eggs in one basket. When you write it down, you're much more likely to remember it and act on it. Step 2. Identify one specific area where this matters in your life right now. Maybe it's that one stock that's gotten way too big, or that pile of employer shares, or a portfolio that's 100% in one fund. Step 3. Take one small action this week to move toward better diversification. That might be checking your percentages, setting a target mix, starting a low-cost index fund, or planning a gradual shift out of a concentrated position. Even a tiny step counts. If you do just those 3 things, write it down, spot where you're concentrated, and take one small action, you've turned this episode from information into real progress. And from here on, every dollar you invest can support you with a sturdier, more balanced foundation, instead of resting on a single, very fragile basket.